Hi everyone. I'm so glad to see you here on this platform to learn about the mutual funds. And I'm very much happy that you have taken that first step to increase your awareness about the investments. Because I strongly believe that with better awareness, you are going to always make better choices with your investments. And with better choices, you're definitely going to see better results in your life. Now, these mutual funds can be used for the wealth creation also, mutual funds can be used for the income generation also, and mutual funds can be used for the capital protection also. So it's very important to learn in deeply about the mutual funds, because people stay away from mutual funds with the one tagline when they see that mutual funds are subject to market risk, and this one statement keeps them away from achieving those milestones in their lives, because mutual funds can really help you uh, achieve that financial success you desire in your life. Now, I will start on with this presentation. So I will briefly go through the topics what we are going to cover in this presentation. First, I will give a brief introduction about myself in the first slide. Then we'll talk about the inflation and how inflation impact our goals. Then third, we'll go in deep into mutual funds, wherein you will be able to learn about the structure of mutual funds. You will be able to learn about the different types of mutual funds, how mutual fund works, what are the risks in mutual fund, what returns it has generated over the past, and then the taxation part of the mutual funds. Then you will understand how mutual funds can help you accumulate the wealth, and then also it will help you in the distribution of the accumulated wealth. Then the most important part is you are going to learn about the financial goals planning today. So I'm going to give you a small exercise while I go through the presentation, so that at the end of the presentation you have your goal in front of your eyes, and it is very much important to invest your money as per your goals. Then in the end, I will take you through the products and services whatever I have to offer you, so that I will be able to help you in your investment journey. So let us begin with the introduction, because I want you to briefly understand about me, and why you should listen to me for the next coming 1 hour. I'm basically an electrical engineer. I completed my electronics and electronics engineering from Goa College of Engineering in the year 2011. And I'm a certified financial planner as well. Now, so this certified financial planner is this certification is the only globally recognized mark of professionalism for financial planners. It is like the highest certification in personal finance you can find anywhere in the world. And this certification is provided by the Financial Planning Standards Board. So this board is from United States of America, so which looks after the CFP certification programs all over the world. And the certification, the CFP mark, what we get is directly from the USA. Now, I'm how you first of all you will now wonder that I'm an electrical engineer and how come I'm into financial planning services. I'll just take you through my journey in brief. Uh, I was working in various companies in the maintenance department as a maintenance manager, and I worked for almost 9 years. And meanwhile, in somewhere in the 4 years back, in the year 2018, I started with my mutual fund distribution services. I got certified as a MFI registered mutual fund distributor. I had to clear one NISM exam wherein I could get that certification. And I had a very much deep interest in the numbers since childhood, and that's the reason I entered into the personal finance topic quite early in my career. So I was researching about various investment options and where I could invest the money, and I started with my ELSS funds. I mean, started with my mutual fund investments way back in 2014. So since then I was following those mutual funds. In the year 2018 I decided I should start by I should help people around me, okay, to start the investments in mutual funds, so that even they can achieve their goals. Then I got certification from IRDAI as an insurance advisor. Also, I do life insurance, health insurance, general insurance, car insurance as well. And I have been advising for over 200 families for past 4 years, and approximately 4 crores of AUM I have been managing since then. And this down, you can see the 3 certifications which I have received from the FPSP board. That is, I am a FPSP certified retirement planning specialist. I am FPSP certified tax planning specialist. I am FPSP certified investment planning specialist, and I am FPSP certified risk and estate planning specialist. Just give me a second. Okay. Let me go to the next slide. Sorry. So, key financial goals. Now, I will give you an example. Suppose, imagine you are standing at Kadamba bus stand at Panjim. Okay, everybody has been there on the bus stand, right? So when you stand at Panjim, and when you go around that bus stand, you see various buses, okay, going to various different locations. Like one bus is going from Panjim to Ponda, one bus standing there which is supposed to go to Mapsa, another bus is standing over there supposed to go to Vasco or Margao, or some other bus which is supposed to travel in the Panjim city itself. And on the other side of the bus stand, there are many Volvo buses, AC buses, which are supposed to travel to the other cities like Kolhapur, Mumbai, Pune, Bangalore, or Mangalore, or some other different cities. Okay. So now my question to you is, in which bus you would get into, or in which bus you would like to travel? Would you like to travel into the bus which has got AC and which has got a sleeper coach inside? Is it so? Or you will try to travel in the bus where you get a comfortable seat? I will answer you that question. You will travel in the bus depending on the location where you want to go, right? Depending on the destination where you want to reach, isn't it? You won't get simply into any bus which you simply into the bus of which the color of the bus you like, you get into the bus. No, no, definitely not. You will know first where you want to go, and then you will identify that particular bus, and then you will get into that bus. Am I right? So in life, in your financial journey also, you should know where you want to go or what goals you need to achieve. Now, I have just taken this picture in front of you, that what are goals you might have. Like some might have a goal of becoming a crorepati, or making a not just 1 crore but 10 crore, 50 crores, or 100 crores of wealth. Some might have a goal of buying their dream house. Some people may have their house, or some people may not have their house. Okay, but they must be having the dream of upgrading their house or buying their first house. Or some people who are married and who are having children, okay, they might be having a goal of giving the best possible education for their children, right? Or most important goal, that is the retirement goal, which is most often neglected goal by the people, because people think retirement as that we will think when we reach at the age of 60, but it's not the case. The earlier you start, the more benefits you can reap from your retirement funds, and you can retire quite early as well. Who says that you have to work till 60 to retire? You can retire in your 50s, you can retire in your 40s as well. So this could be one of your goal, that getting living your retirement life very peacefully. And there might be some other goals, like going to a vacation every year, going to those foreign countries, and exploring the world, and so many other goals. It could be like buying some luxury cars, buying some villas, buying some farmhouses, and anything like that. Okay. So my question to you is, and I want you to take a piece of paper, or not just piece of paper, take a paper in front along with you, and get a pen in your hand. You can pause this video right now, go grab a paper and grab a pen, because I want to do a small exercise with you, and because this exercise is going to help you a lot. Okay, I want you to write down what are your goals. Just think for a while, and write down what are your goals. You can identify as your long-term goals, identify your mid-term goals, identify your short-term goals. I mean, short-term goals is something which you want to achieve in next 1 or 2 years. This will come in your short-term category. There might be something which you want to achieve in next 4, 5, 6 years. That might come into your mid-term goals. And the goals which are like 8 or 10 years long, or beyond 10, like 15, 20 years long, those will come under your long-term goals. Now I want you to identify your goals, and also like what is it that you want to achieve in your life. Ask this question to yourself: what is the ultimate thing that you want to achieve in your life? This will help you identify or write down that goal, and you should have that goal in front of your eyes on the paper. What dreams do you have for your own future, or own future, or what dreams do you have for your child's future? Okay, just go through these 4 questions, write down on the paper what are your goals, what is that you want to achieve in your life, what dreams do you have for your own future, and what dreams do you have for your child's future. I literally want you to write these goals, because in the end I'm going to give you the exercise. In the end I'm going to give you that exercise which will make you to clear your target, or you should have that clear goal or target in front of your mind. This you're going to get at the end of this presentation. I hope you are writing your goals, you have written down your goals. I'm moving to the next presentation. If you're not done yet, you can stop the video, you can complete this exercise, and then only you can move forward. Now, when we talk about goals, about our journey, okay, there is one major hurdle in front of us in that journey, and that major hurdle is nothing but the inflation. Now, what is this inflation? Inflation is the rate at which the prices of the goods and services around us increases over a period of time. I did not have to give you an example. Okay, you are seeing it with your own eyes, how the prices of so many things around you is increasing, right? You are seeing the petrol, how it is increasing, the diesel prices, how it is increasing. Then the grocery items which you buy, the milk, the fruits, the fish, those vegetables, anything if you see around, or even if you go to the restaurant, if you go to the hotel to have a tea, you know how the price or cost of a tea has been increased over the years, right? So this inflation has been growing continuously for past so many years, and this inflation is going to stay in future as well. This inflation is always going to be that hurdle in front of you in your journey, in your financial journey. Why? You will be able to come to know why this is going to be that hurdle, main hurdle in your financial journey. Okay, because this inflation impacts your goals. You will be able to see how it impacts your goals. And what is the inflation rate in India? On an average, the inflation rate in India is approximately 6.5%. Okay, this is the past 30 years data. Even in the past 20 years as well, the inflation is hovering around that 6.5% figure. Sometimes it is 8%, 9% also, and sometimes it has come down to 4 and 4.5% also. But average it has remained around 6.5%. Okay, so what does that 6.5% means? That the prices are going to increase at 6.5% only every year? No, some commodity, some things like petrol and all, they increase at a much higher rate, 8%, 9% year on year. Some things they increase at 3-4% on a year basis. So on average of so many other commodities, if you combine it, the average is coming around 6.5%. Okay, so let us see how the 6.5% growing inflation impacts your goals. If I consider the monthly household expenses of yours, okay, and if you say, suppose if you are spending 50,000 rupees as on today towards your household expenses, then in future, if I consider 10 years later, in the year 2032, you will be able to see the same, to maintain the same lifestyle of yours, to spend for the same household expenses of yours, you have to spend 93,800 rupees for the same household expenses. Okay, if you go 10 years again more far, in the year 2042, you will have to spend 1,76,000 rupees to maintain the same standard of living. without upgrading your standard of living, without upgrading your lifestyle. Okay, for the same goods or services what you consume on a monthly basis, for the to fund for those, you have to spend 1,76,000 rupees 20 years later. And in 30 years later from now, this same amount of rupees of 50,000 is going to cost you 3,30,000 rupees a month. Now, yes, definitely, so your salaries, your income is going to grow over the years, but also your expenses are also going to grow. Okay, so 50,000 rupees is going to cost you around 3,30,000 rupees per month to carry out your household expenses. This is what is coming in the future. If you must have discussed with your parents in the past 20-30 years, they were managing their household expenses hardly in 1,000 rupees also, right? Right, they must be saying, okay, cha and biscuit I mean 1 rupees pitale. Okay, but now the same tea is costing 10 rupees, 15, 20 rupees. So this is how this inflation is growing, and our household expenses are going to grow. I'm going to give you another example, and which is very which is very growing at a very fast rate. That is education cost. Just remember at what was the amount of education, what was the amount you have spent on your education when you completed your graduation or any education. Okay, now and compare that cost with the today's cost, whether the same education is available today in the same prices. I don't think so. So I have got this data from Money Control. One of the research was carried out on the education cost and how fast it is growing. So roughly it is growing at 10% annually. Okay, the prices of the cost of the fees, education fees, is growing at 10% on year basis. So if I say in the year 2021, I have taken this example right away from the Money Control. So what they are saying, to complete the education of a law or graduation in commerce or graduation in science, if say today 8 lakh rupees is the approximate cost, okay, then the same cost in the 10 years later is going to be around 20,74,000 rupees. How much it is? 20,74,000 rupees is going to cost you for the same education which is costing 8 lakh rupees today. If I take the example of engineering, suppose for a student to complete his engineering of the entire 4-year course, okay, 13 lakh rupees is approximate cost today. Then the same cost after 10 years is going to cost you around 31 lakh rupees, considering the 10% inflation in the education sector. Now, I have completed my engineering. I have completed my my electrical engineering in GEC. I will tell you my own example. In the year 2011, when I paid my last term fees, it was something around 8,500 rupees, which is a fees of the 6 months. Now, our college is an engineering college, and these fees which are mentioned here are basically private college fees. Now, in my GEC, the last term fees which I paid was 8,500 rupees, and recently my cousin has got an admission in GEC in the computers department, and she is paying 32,000 rupees as a term fees. Right, 32,000. I was paying 8,000 rupees, so that means almost the fees has increased 4 times in the last 10 years. So in the coming 10 years, we are just considering the inflation of 10%. It is increasing almost like 2.5 times more than the current cost. If I take an cost of an MBA, if MBA is costing around 30 lakh rupees for me today, the same MBA is going to cost 77 lakh rupees after 10 years. Right. So if you have kids and if you are planning for their education, if you are saving or investing money for their future education, have you taken this factor of inflation while planning your goal? I don't think so. Most of you people are planning in this way. Okay, but this is very much important, because the education plan or education policies what you buy today of 10 lakhs, 20 lakhs, it is not going to be sufficient tomorrow. You never know, your kid might do very much excellent, and he might want to go for a foreign studies as well in the future. So at that time, you cannot give them give them a reason that I could not save for your higher education or your foreign studies. Okay, so it is your prime responsibility. You have to plan accordingly by taking that inflation into factor. Then even the cost of a medical to complete the not just MBBS, but this is considering MBBS plus specialization in any one field. So 50 lakh rupees today is the cost of medical education in private colleges, which can go up to 1.3 crores in the coming 10 years. Okay, so why this cost is growing? Because of inflation. And what you have to do to invest, what you have to do is, what you have to do to beat the inflation is you invest your money in the right asset class. And let's see which is the right asset class. Definitely the right investment to beat the inflation is the equity, and you are going to see how equity beats the inflation, how it has beaten the inflation in the past 20 or 30 or 40 years. Now I have taken the example of, say suppose 1 lakh rupees you had invested in the various asset classes in the past 20 years. Now today it is 2022. I have taken the data from 2002 to 2022. If you had invested rupees 1 lakh rupees in 2002 in various asset classes, say suppose if you had 5 lakh rupees, you had invested 1 lakh rupees in the bank FD, you had invested 1 lakh rupees in the real estate, you had invested 1 lakh rupees in the gold, you had invested 1 lakh rupees in the bonds, and you had invested 1 lakh rupees in the equity. Now coming to this graph, now in the first graph, what you can see is the inflation. Now the inflation has increased 6.5% in the past 20 years also. So the 1 lakh rupee should grow to 3.5 lakh rupees. I mean, the things which are costing 1 lakh rupee are going to cost you 3.5 lakh rupees today because of inflation. Okay, so let us compare the our investments against this inflation. Now if I see the bank FD, if I had kept my money in the bank FDs, the average returns from the bank FDs in the past 20 years is around 6.4%. This is without reducing taxes. You know, you are paying income tax on the interest what you gain on your FDs, right? So excluding that, I'm not considering the how much tax it has it has taken. Okay, I'm directly taking the gross returns. What you get is 6.4%. So 1 lakh should grow to 3.5 lakh, close to 3.5 lakhs in the bank FDs, which is almost close to inflation. In the real estate, which is a very disappointing figure, because most of the people think that real estate is the fastest growing asset class. Okay, if I have money, I should buy a plot. If I have money, I should go and buy that residential property. I should go and buy that flat. I should go and buy that commercial property. But believe me, friends, real estate is not growing that much faster than what you anticipate. Okay, it is roughly around 7-8%. In some cities, it might grow around 10 or 11% also. In some cities, it grows at 5% also. So real estate has not been there performing that good. And I have not considered the yields. If suppose you have if you have purchased a flat, and if you have given that on rent and you are earning some income out of it, I'm not considering that, but I'm just considering the value of a real estate on a simple term. Like if you invested 1 lakh rupees in the real estate, it would grow to only 3,86,000 in 20 years. If you had taken a gold of 1 lakh rupees 20 years back, then the same gold is going to the value of the same gold is roughly around 6 lakh rupees. So gold has increased by 9.5%, which is decent enough. Okay, why I am saying decent enough? Because it has crossed, it has beaten that 6.5% inflation. Bonds, if you had invested into, then on an average 9% returns you could get in bonds. So 1 lakh rupees is going to 5,60,000 rupees if you had invested in the bonds. And the 1 lakh rupee which you had invested in equity, it must have grown to around 16 lakh rupees. Now 16 lakh rupees is much higher than any other asset class where you had invested your money. Okay, because equity has grown by 15% in the past 20 years. Now, what is equity? Equity is nothing but a definition of equity is a business. When you invest into any equity in the stock market, okay, you become a part owner of that business. So any stock is performing good, then you get the returns what that stock is generating. So we will cover a brief about equity in the coming slides. So as of now, if you see, the equity is the only asset class which has been able to beat the inflation by a huge margin. So we could generate the wealth almost 5 times more because of your investments into equity. If you compare with the other investment asset classes, also gold and all, your money has grown only 2 times more. Okay, so now the best way and the smartest way to get into equity is nothing but mutual funds. Now, why mutual funds? Because mutual funds has got thousands of schemes available for you as per your need. Okay, like the example what I had given you in the beginning. If suppose you are on the bus stand, standing on the bus stand, then there are like so many buses around you going to the several places. Mutual funds is like that only. If you are at the center and if you look around, mutual funds has got every product for you to fulfill all your needs, your short-term need, your long-term need, your mid-term need, everything. The second advantage is convenience. You can now invest in mutual funds very conveniently through online mode. You need not have to fill those forms, giving those checks and all. Transparency is another important factor. If you compare with any other asset class, whatever investments you are investing into mutual funds, you can see clearly where those money is invested. You can get the exact value of your investments each and every day. If you compare with real estate, if you have a plot and if you are going to sell it in the market, it depends on the market situation, whether the market is in demand, whether the real estate market is in demand, then only you will be able to get a good value for your plot. Otherwise you will have to sell it in very less prices also. So the prices are not that transparent in any other assets like that it is in mutual funds. Diversification of risk. You will be able to understand how the risk is diversified in mutual funds. Mutual funds are not that risky. If you compare it with directly investing in the stock market, it is 10 times more riskier investing directly into stocks. Okay, trading into the stocks, it is 100 times more riskier than investing in mutual funds. Then mutual funds are professionally managed funds. So each mutual fund companies, they appoints a fund manager who are those competent people, and your money is in the safe hands. They invest your money on your behalf. They take a right call with your money so that you get what you desired with your investments. Then low cost returns. The fees what we pay for doing that job of managing our money is very, very less, is very, very, very minimum. Okay, so it gives you that advantage as well. And finally, the tax benefits. You get so many tax benefits when you are investing in mutual funds. And let me tell you one thing, mutual funds is one of the asset class wherein you have a highest tax benefit compared to any other asset class. Like real estate also, taxation in real estate is higher than the taxation in the mutual funds. Okay, so what is a mutual fund? Mutual fund pools investors' money and invest in the various assets like equity, debt, gold, or real estate, as per the objective of the scheme. Now, you will just say that mutual funds is like only investing in the stock market. No. With mutual funds, you can participate even in the debt, like you can invest in those government bonds also, corporate bonds also, other government securities also. You can invest in a gold also. Okay, you can invest through mutual funds like gold ETFs. You have gold funds. You can invest in the real estate as well when you are investing in mutual funds. On your behalf, this mutual fund is going to invest money in some properties which are going to grow. Okay, so this is how you can invest in those funds which invest in those real estate sector as well. So mutual funds is not just like investing in the stock market, and each mutual fund scheme has got its own objective. Before investing in a mutual funds, you have to see whether this objective of the mutual fund scheme meets your own objective, right? Like in the beginning, like I said, you should have a goal in front of you, and you should invest as per your goal. And if suppose this mutual fund scheme is aligned with your goal, then only you should invest in that mutual fund scheme. Now, first mutual fund scheme was started in 1987 by SBI Mutual Fund, and now as on today there are approximately 50 mutual fund companies which are giving their services in India, and there are more than thousands of schemes are available. You will, if suppose you are new to mutual funds, it is very much difficult for you to identify what all schemes are going to beneficial for you, and you won't be able to differentiate the schemes. But there are like more than 1,000 schemes are available, and as on today, approximately, I think close to 40 lakh crore rupees are invested in these mutual funds, and 40 lakh crore rupees have been managed by all these mutual fund companies in India. And roughly Indian 3 crores Indian people are investing in mutual funds as on today. So I have just given these names of the top mutual fund companies in India, right? Like for example, SBI Mutual Fund Company, Axis Mutual Fund Company, Canara Robeco Mutual Fund Company, HDFC Mutual Fund Company, ICICI Prudential Mutual Fund Company, Kotak Mutual Fund Company, UTI Mutual Fund Company, L&T Mutual Fund Company, Edelweiss Mutual Fund Company, Franklin Templeton Mutual Fund Company, Invesco Mutual Fund Company, Mirae Asset Mutual Fund Company, IDFC Mutual Fund Company, Nippon India Mutual Fund Company, which is formerly known as a Reliance Mutual Fund Company. Now Nippon is a Japanese company which has taken over the business of the Reliance Mutual Fund. Then DSP Mutual Fund Company, Tata Mutual Fund Company, Aditya Birla Capital Funds, and then finally LIC Mutual Fund. Now, only most of the people think that LIC has got only life insurance schemes. No, LIC is into the mutual fund business as well. LIC is into housing finance business as well. So people, most of the LIC agents will come and tell you that mutual funds are not good for you. Mutual funds are bad. It will just take away your money. Okay, you will go into loss if you invest in mutual funds. But ask them one thing: whether are you aware your LIC company has got a mutual fund as well? And then if the mutual funds is bad, then why LIC is operating in the mutual fund business as well? Okay, so mutual fund is not like those Ponzi schemes which tells you that you will become rich in 3 months or you will multiply your money in 1 year. No, mutual funds are a long-term investment products. Mutual funds are a well-organized product, and they are well regulated by the Security Exchange Board of India. Like how Reserve Bank of India controls all the banks. In the same way, Security Exchange Board of India, that is SEBI, controls all the mutual fund businesses in India. Now, you will understand the role of SEBI here when I will discuss about the structure of mutual funds. So basically, in this picture, you are seeing these unit holders, which are and the SEBI, which are highlighted in blue. So unit holders are the people are the investors, people like you and me who invest in the mutual funds, and SEBI is the one who control all these entire processes, like who all are there, key elements are there in the mutual fund structure. If I go through them one by one. The sponsor is the company which is responsible to set up the mutual fund. Like in the past, in the last slide, what we saw is the SBI Mutual Fund or HDFC Mutual Fund. For those, the sponsor is SBI Bank. SBI Bank is the sponsor of SBI Mutual Fund. HDFC Bank is the sponsor of HDFC Mutual Fund. Axis Bank is the sponsor of Axis Mutual Fund. So and so that mutual fund has got their own sponsor. Once they have a sponsor, they form a trustees. Okay, trustees are the people who are authorized by the SEBI also and authorized by the sponsor also, who regulates and follows the guidelines in the mutual fund business. Okay, so the trustees take care of the mutual fund business. Then AMC, that is the asset management company. Okay, asset management company. Now SBI Bank is the sponsor, SBI Mutual Fund is the asset management company, or you can call it a mutual fund company. So they appoint a fund manager to manage the funds. They appoint a fund manager who will decide in which stocks or securities that money is to be invested. Who that is the person who takes the call on the investments part, and he is the person who is responsible for your money to grow. Okay, then the custodian. Now fund manager is only responsible for managing a fund. So this fund, where it should get invested, these funds, how much funds should be invested into those particular securities or particular stocks. Okay, but the securities are not with the mutual fund company, the securities are not with the fund manager, securities are not with the sponsors. The entire investments, whatever the mutual fund company is managing, is in custody of a custodian. And there are like a regulated custodian in India which are authorized by the SEBI to do that part. Okay, and finally is the RTA. RTA is the registrar and transfer agents which are responsible for processing the applications. Okay, whenever the investors want to invest in the mutual funds through the online mode or through the offline mode, they go through the RTAs, wherein RTA helps them to invest the money in the mutual fund. So these are the key players in the mutual funds. There are other key players also, like mutual fund distributor, mutual fund advisor, okay, who are like who has got the license to operate in that particular field to distribute the product or to advise a product, and these licenses are given by the SEBI as well. And as per that, there are many some small players in this structure. So now how this mutual fund works, this is very important for you to understand, because you should know that the working of the mutual fund, so that you get that confidence of investing in mutual funds. So in this slide, you see the investors with the bag of money in their hands. These are us, people like us, people like you, people like me, okay, who want to grow our money. Okay, we are the people who want to grow our money. So we invest our money in one particular mutual fund scheme after knowing that objective of the scheme, what it is going to give me, and whether it is aligning with my goals, whether it is aligning with my risk profile. Then I invest in this particular scheme. Now, this mutual fund scheme, each mutual fund scheme has a dedicated fund manager to operate the scheme. Now, the fund manager is appointed by the asset management company or mutual fund company. He is that professional with the highest qualification in the finance, with the highest knowledge and with the highest experience, who is been appointed as a fund manager. He is provided with all the resources, whatever is required, like infrastructure, the technology, and also the team of 15, 20, 25 people. Okay, so that they research on daily basis on the stocks, they research on the market, they update themselves with the news, update themselves with the whatever new stocks and all are coming, how they are performing, what are their results, what are their financial results, what are the management decisions their management is taking. And after doing all this study, they identify the stocks and they invest the money in the stocks or other bonds or in the gold or in the real estate, depending on the scheme. So it is the fund manager who decides where to invest the money. Okay, then these are the securities. Whatever names I have taken right now are the securities. We call it assets, like whether it is in the stocks, whether it is in the bonds, whether it is in the real estate, or whether it is in the gold, right? So these are the securities which are selected by the fund manager. Now, over the years, how these securities perform, okay, how the money grows in those securities, like gold prices are increased, then our money invested in mutual funds increases. The real estate prices increases, then our money invested in that particular fund, which is consist of real estate, increases. If the stock market, if some of the stocks increases, then those particular money which we invested in those mutual funds having those stocks is going to increase. So similarly, the amount of returns what is been generated by these different securities are then directly passed on to the investors. Okay, and there is a very small fees which is being charged in between, which comes under the expense ratio of the mutual fund scheme. Okay, so this is the simple working of the mutual funds. Investors invest money in the mutual fund schemes. Fund manager take care of the funds. He decides where to invest the money so that he can generate more returns, and the returns what are being generated are then directly transferred back to the investors. Okay, if you are facing any questions in between, okay, if you are facing any questions in between, you please note it down on the paper so that we can discuss further, and we can take up your questions also in some later sessions. So now let us understand the types of mutual fund. So mutual funds, like I told you, there are like thousands of schemes available, right? So mutual funds has various investment options for you to fulfill all your goals, all your investment horizons, whether it is for 6 months goal, whether it is for 1 year goal, whether it is 3 year goal, 5 year goal, 10 year goal, 20 year goal, 50 year goal. Okay, you have all the investment horizons if you want to invest in mutual funds, and depending on your risk profile as well. So everybody has got, everybody has got risk taking attitude. Okay, so once your risk taking attitude is identified, then only you will be able to see like whether that scheme is suitable for you or not. So let us see the mutual fund categories. Okay, I have taken these 3 primary categories in mutual funds. There are more in detail categories also, subcategories also, but if I consider the debt mutual fund is the category which is suitable for investment from 0 to 3 years, which is suitable for a short term period. And debt mutual fund are the schemes wherein you get a fixed returns, which is approximately 6 to 7% or 8% returns, depending on the type of bonds they are purchasing, like whether it can be a government bonds, or it could be a corporate bonds, or any other bonds available in the market, which gives the fixed returns. Okay, so debt mutual fund is for a shorter duration. You can invest in a debt mutual fund for 5 years, 10 years as well. Okay, provided you are satisfied with the fixed returns you get in those mutual funds. Okay, then the second category of mutual funds is the hybrid mutual funds, which is the mix of a debt and equity. Now, debt is investing in a bonds or investing in the government securities where you get a fixed returns, and equity is like investing in a stock market. Okay, so in equity you have a potential to get higher returns. Okay, so but you have to stay invested for a longer period of time. So when you're investing into equity, okay, you get exposure to the stocks. So where the stocks are, the vulnerability is there. It depends highly on the market performance. It depends on the other scenarios wherein the stock market varies a lot. But over the long period of time, the stocks also give decent returns. It can be 12 to 15 or maybe 18, 20 or more than 20% returns also. Right. So I was talking about the hybrid funds, which are suitable for the medium duration, like 3 to 7 years duration you have for of your goal, or if you want your money in 5 years, 6 years, then hybrid mutual funds are more suitable, which is a combination of equity and a debt. Okay, some portion of the money is getting invested into equity, some portion of the money is going to invest into debt. So some money is going to grow faster, some money is going to go at a fixed rate. Okay, and the third category is the equity mutual funds. So equity mutual funds is a category which is suitable for a long-term investments. Mutual funds wherein you have some long-term goal of 8 years, of 8 years, 10 years, 15, 20 years. Then equity mutual funds is the most suitable one. And believe me, in that long run, equity mutual funds has the ability to multiply your wealth. But don't expect that mutual funds to give you returns in a short term, like 2 years, 3 years, 4 years. No. When you are investing in equity mutual funds, you should sit and you should have a patience, like if you have the patience of watching the tree grow right from the time you plant the seed, and if you have a patience to see that tree growing like coconut tree, okay, it takes 7-8 years to grow completely, and then it starts giving you fruits, right? So equity mutual funds is the same way. You cannot check on this returns every 6 months, every month, or every year, right? So you have to give enough time for the tree to grow, and then only you will be able to reap the benefits of that tree. Now, this is very important, riskometer of mutual fund. You have to identify the riskometer, or the risk, how much they are carrying, every mutual fund scheme which is carrying. Okay, and accordingly you will have to see whether that riskometer is suitable for you or not, whether it matches your risk profile or not. Okay, and then only you should take a decision of investing in the mutual fund. Like now, debt mutual fund it has a very low, most of the debt mutual fund has a very low risk, low to moderately low risk. Okay, when it comes to hybrid mutual funds, it comes under the category of moderately low to moderate risk. Okay, and when it comes to equity mutual fund, equity mutual funds is always like moderately high to high risk. So these three mutual fund categories, depending on the investment horizon, depending on your expected returns, and depending on your risk profile, these three main categories are divided. There are other categories as well, like gold funds, like real estate funds, like there are various other funds. Okay, ETFs, passive funds, international funds. We won't go deep into it. For our basic understanding, these three things are enough, and you are completely new to this information is more than enough for you, and these kind of funds are very much suitable for you, okay, to grow your money. Then slowly, once you build the knowledge, then you diversify into other schemes or different types of schemes. Now, mutual funds are subject to market risk, and this is the just give me a second. Okay, mutual fund investments are subject to market risk. So mutual funds are subject to market risk. This one sentence creates a fear in the mind of investors. And what I believe, that risk is something wherein you don't know what it is and you are investing into it, then it is risky. And if suppose you know what it is, you understand all the parts of it, and then you are investing into it, then I believe the risk reduces a lot and risk goes to minimum. Okay, this is the reason why I have created this video specially for you, to go through the basic understanding of mutual funds, because mutual funds are subject to market risk. But if you understand those risks, then you can change your life completely with that. I believe that you are going to see a vast difference in your life if you start believing in mutual funds in the coming years. Okay, so let me just continue. So there are various risks in the mutual funds. These are subject to market risk is just one part of it, but there are like management risks also. Then there is something called as liquidity risk also. There is something called as interest rate risk also. There is something called as credit risk also, and there is something called as inflation risk also. So these are the various risks which are there in the mutual funds. Okay, so now you were only you were worried about only one risk, that was the market risk, and now I have given you the five more risks, right? And there are even more five risk type, I mean subcategory of risk. Okay, which which will make you run away from the mutual funds. No, I won't allow you to do that. So if you say this risk, if you consider all this risk, in spite of that, this Sensex has given you 16% returns in the past 43 years. Now, Bombay Stock Exchange, BSE is Bombay Stock Exchange, okay, which denotes our stock market, which was started in the 1979, and the value of the stock market was 100 that time. Now today it has reached to 60,000 level, and it has gone through so many risks in the past 43 years. Like we have gone through two major war, okay, against Pakistan. Then we have gone through many financial scandals in between. Or two prime ministers got assassinated in those years initially. We have gone through three recessionary periods. Okay, recession is when the people lose their jobs. Our economy had collapsed. Okay, then there were 10 different governments which has formed in the past 40 years. Natural disasters, we had seen so many earthquakes, tsunamis, terrorist attacks also, okay, which has affected a lot. We have seen the global crisis in the year 2000 and also in the year 2008, wherein the economy was completely crashed globally as well as in India as well. And the recent COVID-19 pandemic as well, which had, the world was at steel in the 2 years back, right? So in spite of that, today Sensex is standing at 60,000. It had started from 100. And if you see the returns, it has generated approximately 16% returns in the past 43 years. Okay, so how the Sensex was able to deliver this much amount of returns? It's simply because of this, the graph, the picture which I'm about to show you right now, right? The picture in front of the screen. Now, this market has grown so much only because of our consumption. The more and more we consume, more and more these companies which are listed in the stock market make profits, right? The mutual funds invest only into those companies which are listed on the stock market. Like if I name few of them, like Hindustan Unilever Limited, Nestle, Maruti Suzuki, Asian Paints, Ultratech Cement, Tata Motors, and so many others are there. There are like 3,000, more than 3,000 companies which are listed on the stock exchange. So if we see, okay, in our household consumptions, we consume so many things around us. If you see, okay, we consume those products. Okay, we utilize those products in our day-to-day needs. And more consumption is more and more sales those companies are making. More and more sales they make, more profits they generate. more profits they generate, they reinvest those profits in their expansion in their production capacities. They come up with the new products, they come up with the new manufacturing plants. More and more people get employment, more and more people start earning more money, and then again that spending cycle again begins. So this is how Indian economy has been grown for past so many years, and in the future also we expect Indian economy is going to grow that at that much rate. If we see, the corporate profit growth is directly proportional to the economic growth. Okay, so India as an economy is a developing country. India has been growing economically in the past so many years. In future also we are seeing that growth potential, and the corporate growth, I mean the stock market growth is directly proportional to our Indian economic growth as well. India as a country has a strong growth story because so many measures which has been implemented right now in India by this current government, like Digital India, Atmanirbhar Bharat, Make in India, GST implementation. This has, increased the confidence of those foreign investors, foreign businesses to come and invest in India. And this is why Indian growth story is very high, and India might know. I believe that India is going to come in the top 3 economies in the decade to come. India is definitely going to come in there. And being an investor, okay, we just have to invest in our money in the Indian equities, wherein we'll be able to take the benefit of this growth story, right? So equity has the biggest potential to deliver the excellent returns, my friends. So don't run away from equity. Whatever the risks are, understand those risks. Okay, and mutual funds are the best way to minimize your risk. You need not have to do anything. Those fund managers will take care of everything, like how you invest your money in those LIC schemes, how you invest your money in the bank FDs, how you invest your money in the post offices or in the PPF account. You just go and just deposit your money there. Rest all is taken care by that institute. In the same way, in the mutual funds also, you do not have to do anything. Okay, you do not have to scratch your head. Your mutual fund advisor or distributor will advise you or guide you in which particular scheme you should invest. You just invest into that scheme and just close your eyes. You just open your eyes when your goal arises. Your mutual fund is going to deliver you the returns. Okay, so let us go to the next slide. I think I have covered mutual funds part, overview of it, the different types of mutual funds you have seen so far, different risks in mutual funds you have you know now, different how returns has been generated by the mutual funds in the past. I have shown you the mutual fund company names of the mutual fund company. I definitely feel that now you will be comfortable with the mutual funds with the amount of information I have given you so far, right? So now let us come to the important topic, that how mutual funds will be helping you to create the wealth in your life, right? You have seen how mutual fund works, how it take care of your investments, then but let's just see that how it can help you grow, right? How it can benefit yourself. Now suppose if you start investing in mutual fund on a monthly basis, what you have heard recently is a SIP, right? Systematic investment plan. The full form of SIP is, that is a investing in investing in mutual funds on a monthly basis. It's called SIP. Like I have seen a nice video on YouTube wherein she had explained, one lady had explained the difference between the SIP and lump sum investments in mutual funds, right? She had taken one gulab jamun. Okay, that gulab jamun you can eat directly, one at a time. Okay, or that gulab jamun you can take a spoon and you can take it in a plate and you can have it in piece by piece, piece by piece, piece by piece, piece by piece, right? So you have two options. Either you can eat it directly or you can eat piece by piece, but finally it is going in your single stomach only, right? You don't have a different stomach to eat that gulab jamun in pieces or as a single piece, right? In the same way, in mutual funds also, either you do SIP, that is in monthly, month on basis, or you can do one at a time as a lump sum investment. Finally, it will go in the mutual funds only. So SIP is no different than mutual funds. Okay, so it is a way of investing in mutual funds. So now let us take an example. If you are investing 10,000 rupees, if you're investing 10,000 rupees in mutual funds for 20 years, okay, 10,000 rupees per month for 20 years. So total amount you are investing is approximately 24 lakh rupees. right? And you, if you see here, okay, if you had invested the same money, in LICs or bank FDs where you get on an around 5% returns, okay, 24 lakh rupees grows to around 40 lakh rupees. If you had invested that money in PPF, NSCs, or senior citizen savings, uh, Sukanya Samriddhi account, okay, the 7% returns you get over there. So your money, 24 lakhs, will grow to 51 lakh rupees. But if you compare it with equity mutual funds, wherein if I expect only 15% returns from the mutual funds, the same 24 lakh rupees will grow up to 1 crore 32 lakh 70,000 rupees. Tell me, friends, you had to take any efforts for 20 years? No. If the same way you invest in the banks, you invest in the LICs, or invest in the PPF or other accounts, in the same way, if you invest in mutual funds, your money is going to grow sitting at home. You need not have to take any additional efforts to grow your money this much. Like you can see, it has grown almost 2 or 3 times more than where you could have got on the other traditional schemes, right? In the same way, if I take an example of lump sum investments, okay, if I take an example of lump sum investments, that is like I told you, one-time investments, right? So if you make a one-time investment of 10 lakh rupees today, and if you keep it for 20 years, okay, one-time investments of 10 lakh rupees for 20 years, let us see how much it grows to by investing in various assets. If you had kept 10 lakhs in the bank FDs, in 20 years it will grow to 26 lakh rupees. If I keep it in the post office or national savings certificate or senior citizen savings schemes, then this 10 lakhs is going to grow close to 40 lakh rupees. But if you invest 10 lakh rupees in the equity mutual funds, then the same 10 lakh rupees is going to grow to 1 crore 63 lakh rupees. Now, 1 crore 63 lakh rupees is not the exact amount you are going to get, because as I told you, equity mutual funds are not going to give you the exact same returns. It will depend on the market, but possibility is there to get returns over and above 15%. You can get 1 or 2% plus or minus. It can go 17-18% also. It can go 12 to 13% also. But if we see the average returns in the past 20 years, it has remained around above 15%, and the so much amount of wealth has been created. So your wealth has been multiplied 16 times in 20 years, just sitting at home. You need not have to do anything. Okay. Now, once you have created this wealth, now how you can use these mutual funds for the wealth distribution? And for the wealth distribution, the best way is to invest in the hybrid funds, hybrid equity funds. Okay, so let us see. Now, if you have a lump sum money, okay, with you, I have taken one small amount. Most of the people invest in most of the people invest in those Pradhan Mantri Vaya Vandana Yojana or senior citizen savings schemes, or in the post office or in the banks to get the monthly income. So they invest one time 15 lakh rupees lump sum amount, and they get on an average 6% returns out of those schemes. So monthly income they get is approximately 7,500 rupees. And the maturity is 10 years, say suppose, then after 10 years, you get your 15 lakh rupees back. And throughout those 10 years, you will get 7,500 rupees on a monthly basis. Now, let us see if the same amount, if you keep it the hybrid equity funds, what happens to your 15 lakh rupees. So you invest 15 lakh rupees in the hybrid funds, and you choose the SWP option, that is systematic withdrawal plan. Same as a monthly income scheme, it is a systematic withdrawal plan in the mutual funds. So 15 lakh rupees, you expected returns in the hybrid funds is approximately 12%. But these hybrid funds on month, it is going to give you 6% returns back to you. That is 7,500 rupees. Same what you get through your post office or bank MIS schemes. So monthly 7,500 rupees is you get through these hybrid equity funds. And after 10 years, the maturity amount what you get is approximately 30 lakh rupees, which is almost 2 times than on your initial amount. Why this has happened? Why this has happened? This is because the major difference those two things. Sorry, the major difference into those two things is the 12% returns compared to 6% returns in the banks or a post office. So that means you get higher returns in the hybrid funds. Out of this 12% returns, 6% returns are given to you on a monthly income basis, while the rest of the 6% returns are invested back into that particular hybrid funds to grow. So that's why after 10 years, you get your wealth multiplied by 2. Okay, so this is one of the best option for the person who is retired or a person who is a businessman who has got a already accumulated wealth. Okay, and he wants a steady flow of income for his family, for his monthly expenses. Okay, for those kind of people, these hybrid funds are the best. Whereas in the previous slide, which I showed, the SIP investments or lump sum investments, these are good for those people who wants to create wealth in their life, who want to achieve, invest for their goals, future goals. For them, it is good. Now, going through the third option, that is debt mutual funds, which are a best alternative to the bank FDs. So this best alternative is available only because of the tax benefits you get in the mutual funds. If I compare the person who is invested, suppose 25 lakhs in the bank FDs, and if the money is kept invested in for 3 years, okay, so 25 lakhs with interest amount, it grows to around 4,77,000 is the total interest amount generated in the 3 years. But the tax total you pay, if you come in the 30% tax bracket, then approximately 14%, 14,000, sorry, 1,43,000 is the amount you pay as a income tax of the interest amount generated. So net gains, what you get is 3,34,000. So after 3 years, the maturity value is 28,34,000 in the bank FDs. Now, these debt funds are best suitable for the person who says that I don't want to risk my money investing into equity. I want to invest my money somewhere. I will get a fixed returns. I'm okay with less percentage of returns, but I'm happy to get a fixed returns. Okay. So if you invest 25 lakh rupees in the bank FDs, you say suppose you get 6% returns, you might get 7% also. Okay, but say suppose if you get 6% returns, and if you keep this money for the 3 years, there is a taxation benefit in the debt funds if you keep the money only for 3 years. If you are keeping money less than 3 years, then the taxation is the same as it is for the bank FDs. But if you keep the money for 3 years, then there is something called as a long-term capital gain tax, and you get that inflation indexation benefit, okay, which I will cover in the next slides. So wherein you get a tax benefit. So if you see the interest amount generated with 6% returns is 4,77,000 rupees, but the tax payable here is only 29,000 rupees, wherein the tax you pay in the bank FDs is 1,43,000 on the returns whatever is being generated. So the net gains are higher here, and the total maturity value is approximately 29,48,000 when you invest in the debt mutual funds. If you see the total savings on 25 lakh rupees, you approximately save 1,13,000 rupees by investing in a debt mutual fund. And if I expect 6% returns, the returns might be more also. Okay, so this much amount of money you can save for yourself, okay, rather than paying tax to the government if you take a call of investing in the debt mutual funds rather than investing in the bank FDs. Now there is another category of mutual fund that is called ELSS funds, and this is one of my favorite because as an initial investor, I always recommend, if you are new to the investor, start with ELSS funds. These are very basic funds. These are government has given opportunity to every individual to save tax under Section 80C by investing in these ELSS funds. And for the same reason, I started my investment journey in mutual funds with these ELSS funds to save tax under Section 80C. I do not wanted to invest in those LIC schemes or PPF or other schemes wherein the lock-in period is 10, 15 or 20 years. I did not wanted to keep my money blocked for so long. So I decided to invest in these equity funds. Okay. So now the advantages of ELSS. Okay, the advantages of ELSS, why you should invest in ELSS funds rather than those traditional funds is first, very low lock-in period. You just have the lock-in of just 3 years. Your money is locked. After 3 years, you can redeem your money at any point of time. You have the higher growth potential in mutual funds, in ELSS funds, because of the equity part. 80% of the funds you invest are invested into the equities, and rest 20% is in other securities. But because of the 80%, you get opportunity to earn higher returns in ELSS funds. You get a tax saving under section 80C also. You have an option to invest through SIP, and you get the benefit of power of compounding. I will cover that power of compounding in the coming slides. Okay, but you get your money multiplies when you invest in ELSS funds, and most important is you can continue in your investments even after the lock-in period. It's not like other schemes wherein once at maturity your money doesn't know to grow, you have to redeem all the money. In ELSS funds, it is very much convenient that you can stay on investing in the funds, or if even after 3 years, if you keep your money invested there, only your money is going to grow as per the market. So this is another added advantage of ELSS funds. Now, if I compare ELSS funds with other category, if you invest for 15 years, 1,50,000 is your yearly contribution. Why I have taken 1,50,000? Because it is the maximum limit available under section 80C. Okay, so for 15 years, you are investing 1,50,000 rupees year on year basis, and your total investment is 22,50,000 for those 15 years. So you have put 22,50,000 rupees for 15 years in particular investments for saving tax. Now, if you had put it in ELSS funds, then with the 12% returns, the 22,50,000 will grow to 62,62,000. Whereas in PPF with 7% return, it will grow only to 40 lakh rupees. And in LICs with 5% returns in 15 years, that money is only going to go to close to 34 lakh rupees. So you can almost create a wealth of 2 times more by investing in ELSS funds, right? So let us come to the taxation part in mutual funds. So first category is a debt mutual fund category, where I had just told you about that clause of 3 years. So whenever you invest in the debt mutual funds, and if you invest for a less than 3-year period, then the returns what are generated is counted as a short-term capital gains. Okay, short-term capital gains. Whereas if you have kept your money in debt mutual fund for more than 3 years, then it is counted as a long-term capital gains. So for short-term capital gains, the tax rate is the amount of interest whatever generated is added in your income, and it is taxed as per your tax slab. While when you invest for more than 3 years, then you get the indexation benefit. Okay, you get taxed for 20% after indexation. That means there is a cost inflation index. Okay, and comparing with the cost inflation index, you get a 20% taxation, so which is very less compared to the direct slab rate. Okay, and whatever dividends if you receive in these debt mutual funds, they are taxable in the hand of an investor, and the dividend amount is more than 5,000 rupees, then the 10% TDS will be deducted, and the rest of the amount will be transferred to your bank account. Okay, so the amount, then you can do the return filing and get the tax amount returned back. Okay, so this is about the debt mutual fund. Another category, which is the equity mutual fund, or whether it is the direct stocks or whether it is a hybrid funds which are equity oriented, then the taxation is like this. So here the short-term capital gains is if you invested only for 1 year or less than 1 year, if you are redeeming the money, then whatever gains that are being generated are taxed at 15%. See, this tax is only on the gains what are generated, not on the your principal amount. Okay, whatever gains or whatever returns are being generated, those are taxed at 15% if you remove the money in 1 year. If you remove the money after 1 year, say suppose if you invested for long term, and if you are redeeming the money after 1 year, then you have a flat tax rate of 10%. Okay, you have a flat rate tax rate of 10%. Initial 1 lakh rupees is tax free. Okay, 1 lakh returns. So suppose 10 lakh rupees you have invested, and total you have generated 15 lakh rupees. That means 5 lakh profits you have generated. Okay, 10 lakh rupees you have invested, you have generated 5 lakh rupees profits on that. In long term, total you get 15 lakh rupees. Out of that 5 lakh rupees, 1 lakh rupees is tax free. So rest 4 lakh rupees will be taxed flat 10%. So on this 4 lakh rupees, 40,000 rupees is going to be paid by you as a long-term capital gain tax. You understood this taxation part? I hope you understood it. If you are not understood, you go through this taxation part again. Okay, you can rewind it and you can watch this video right from this taxation part, so you can understand it better. So again, the dividends are also taxed in the hands of the investors. Okay, if it exceeds 5,000 rupees, if the dividends are less than 5,000 rupees, then it is not taxed. Now, the important part here is financial goals planning, right? I hope you have those goals in front of you, which I had asked you to write down in the beginning of the video, right? So I want you to have these goals in front of you, because at the end of this slide, okay, you are going to get an important formula to know your target amount, to know your target, to know your goal, okay, how much you will need for your particular goal. Okay, so now let us take an example of a retirement goal. If you are saving for a retirement goal, now suppose if you have a one figure in mind, or if you have calculated that 1 crore is the amount which I need to achieve as my retirement target, okay, as a retirement goal. Now the important thing is, what will be the cost of that goal in the future when I retire. And if I say, if I am going to retire after 30 years, then the 1 crore, you have to calculate what is the future cost of it. So if I calculate the future cost of 1 crore is 7.6 crore with inflation of 6.5%. So this is very much important to consider the inflation. Like I told you in the beginning of the presentation, in the initial slides, how inflation impacts your goal, how much the monthly expenses is going to increase in future. So in 30 years, in today's term, if 1 crore is enough, then in 30 years, you will need 7.6 crores approximately to live the current lifestyle, or to maintain the current standard of living. Okay, so what are your options to generate that 1 crore? Either you can invest in the equity, which I have told you right now, wherein you can generate 15% returns, or you have the other option of investing in the fixed income, wherein you get not more than 7% returns today, right? In the other various assets, if you see, post, banks, or wherever you see, you don't get more than 7% returns, right? So if I compare the equity with fixed income, the monthly SIP I need to do in equity is 13,500 rupees if I want to achieve the target of 7.6 crores. While if I want to achieve that 7.6%, 7.6 crore target by investing in fixed income investments with 7% returns, then the monthly investments is approximately 64,500 rupees. Just see, you have to invest 5 times more to generate the same amount of money after 30 years. If you take that call of investing in equity, you can make that huge corpus with just small SIP of 13,500 rupees. The second option is the lump sum investments, wherein you keep the one-time investment today and you remove that money after 30 years, right? So if you keep the money in the equity, just 11 lakhs 47,000 rupees today for a long term, for 30 years, this 11 lakh rupees is going to grow to 7.6 crores. Amazing, right? This amount is multiplying almost, I guess, 70 times more in 30 years in equity. Whereas if you are keeping that money in the fixed income, okay, if you want to keep money in the fixed income, then you have to invest close to 1 crore rupees today for that money to grow to 7.6 crores. You are getting the clear difference, right, of investing into equity and investing in a fixed income. And this equity really creates a magic in the long term. But it's the only thing that you should have the patience of staying for a longer term. Okay, now coming to I have taken some other goal, like child higher education goal. If you have a children, if you're planning for their education, now say for example, present cost of education is 20 lakh rupees, and if you are planning for that their education after 15 years, okay, then if you calculate, the future cost is going to around 55 lakh rupees. So you have the target amount of 55 lakh rupees in front of you. So now you have got two options to invest to achieve the target amount, either to invest in equity or either to invest in a fixed income. If you plan to invest in equity, you should do a monthly SIP of 8,900 rupees, or a one-time lump sum investment of 6,76,000 rupees. Whereas where you are investing into fixed income, you have option of doing monthly SIP of 17,000 rupees, or one-time investments of 19 lakh rupees, close to 20 lakh rupees. So I believe that you can differentiate very well. These numbers doesn't lie, the calculations doesn't lie. Okay, you have the clear picture in front of you, what you want to choose to make your goals or dreams come true, right? So friends, if you have written down the goals in front of you, I want you to write down what is the current cost of that goal. If suppose you have written retirement goal, write down the current amount, okay, current amount that you need for your retirement. Or if you have written an education goal, okay, you write the current cost of the education which you need to you want to provide for your kid. In front of that, write down the number of years for that goal. Like retirement, I have taken it example. Now retirement is due in 30 years, right? I have written the example here, which is in 30 years. Whereas the child's higher education, which is due in 15 years. So write down the number of years. And now I present you that formula of calculating your future cost. Now future cost is equal to your present cost, what you have written right now, your present cost multiplied by, in the bracket, 1 plus inflation rate. Now what is the inflation rate? The rate at which the prices are going to increase. And if you are considering the retirement goal, take that inflation of 6.5% or 7%. If you are taking the goal which is education, then take the inflation as close to 10%. If you are taking any other goal, okay, keep the inflation in the range of 7 or 8%. Okay, so that you get a exact, you get a approximate value, closer value which you need in the future. 1 plus inflation rate to the power number of years. You just have to do this calculation. Better to do it in the Excel. Okay, you just have to write is equal to present cost, that star multiplied by 1 plus inflation rate. Write it in the term of percentage, 6% or 7% or 8%, whatever the inflation rate it is. Write it in the percentage, close the bracket, use the to the power option and the number of years. And when you enter, you will get the future cost of your goal. You will have right in front of you, right in front of your mind, what is the amount you need for, you need to achieve, or the target what you need to achieve for that, to fulfill that goal in future. So I have given you the clear picture of how much you need to create, okay, to fulfill your goal, right? Now this power of compounding, this is another magic. It is actually considered as the eighth wonder of the world, that is power of compounding. Albert Einstein had quoted it once. Why? Because what is compounding? Compounding is nothing but your investment returns, whatever is being generated, your returns or interest amount generates more interest amount on that, right? In this example, let us take the compounding with 15% interest rate. If suppose 1 rupee is invested, so with 15%, it will take exactly 5 years to become 2 rupees, right? 1 rupee will become 2 rupees in exactly 5 years with 15% returns. Now in next 5 years, this 2 rupees is going to grow to 4 rupees. These 2 rupees are going to grow 4 rupees in next 5 years because of compounding. Now initially only 1 rupee was base amount, right? This was the interest amount. In the next 5 years, this also the base amount and the interest amount are multiplying by 2. In the next 5 years, if you see, the all the principal and the interest amount are multiplying by 2. So 4 rupees becomes 8 rupees in the next 5 years, and so on. So after every 5 years, this because of power of compounding with 15% returns, after every 5 years your money gets doubled. So why this power of compounding is important here? Why I have shown you this? Your 1 rupee can create the wealth in multiples. It can multiply by 2, it can multiply by 4, it can multiply by 10, it can multiply by 20. Okay, whatever current value you have, it is going to multiply, provided you stay in investing your money for a longer duration of time, for that much years. So this is very much important, because if you plan your goals well in advance, right? Like for example, retirement. If you wait till you reach at 50 to plan for your retirement, you get only 10 years to grow your money. So in 10 years, your money is going to grow only by 4 times. But if you start planning your retirement at the age of 30, right? If you start planning right from the age of 30, you get 30 years to create that retirement purpose, and you can multiply your wealth 64 times more. 1 lakh can become 64 lakhs in 30 years. 1 crore can become 64 crores in 30 years. due to power of compounding. And in the power of compounding, there is one simple formula what you should note down. Okay, that is, I call it a rule of 72. Okay, you will find it on Google as well. And this is very much important formula, because this formula help you to this formula will help you to multiply your wealth. Okay, so what this power of rule of 72 tells you: 72 divided by annual percentage returns, what you get, 72 divided by annual percentage returns is going to give you the number of years to double your investments, right? 72 divided by annual percentage returns is going to give you number of years to double your investments. So if I divide 72 by 15% here, so answer is close to 5. So that's the reason your money is going to multiply by 2 after every 5 years. Now let us take an example that you are getting 7% returns in those fixed income category. In the post you get 7% returns, or in the other schemes you get 7% returns, fixed returns. So 72 divided by 7, you get 10. Answer is 10. That means 10 years it will take to double your money. So after every 10 years, your money is going to multiply it by 2. Now tell me, friends, what is the interest rate, current FD interest rate in the SBI bank or any national banks? Approximately 5%, right? Approximately 5% is the current interest rate on the bank FDs. Write down on the paper, apply this formula to that interest rate. 72 divided by 5%. 72 divided by 5. The answer is 14. Right? So are you happy to multiply your money? I mean, double your money in 14 years? Then I think you should go ahead and stay invested in the FDs. If you want your wealth of 1 crore to become 2 crore in 14 years, right? Then I think you should be, if you're comfortable with this, then I think you should go ahead and invest your money in the bank FDs. But in the same 14 years, if you invest at 1 crore in equity mutual funds, this wealth is going to grow to 8 crores, right? This wealth of 1 crore is going to grow to 8 crores. And this is how the power of compounding grows your money over the period of time, right? So I have finished with my presentation. I'll just go through the topics what we have covered in the today's presentation. First, I helped you identify your goals, right? I hope you have written your goals. I hope you have, have the target amount in front of you. Then how the inflation impacts your goal, right? You have calculated how much money you will need in future, so you know how the inflation is making your goal, making your goal go away from you, right? Then you know how to beat that inflation, okay, how to achieve that goal quite faster or more easier. You have seen the equity. Then mutual funds, you have understood the structure, the types, that working, the different risks and returns in mutual funds you have seen in the past as well. Okay, then you have seen the how wealth creation has been done through the mutual funds. Okay, how you can multiply your wealth in mutual funds, how you can take this wealth distribution opportunity from the hybrid funds. You get the SWP option in the hybrid funds. Okay, then we have covered the debt funds for a fixed income category. Okay, if you want something in a fixed returns and you want a more tax efficient returns, and debt funds is a very good option against the bank FDs. Then you get you also the ELSS funds, wherein you get a tax benefit under section 80C. Then you saw how the taxation in the mutual fund applies long-term capital gain tax, short-term capital gain in the equity, and also in the debt funds also. And how the financial goals planning needs to be done. Okay, how to identify your goal, how to set the target in front of you, and how you have to plan that goal. Okay, and finally the power of compounding. How it multiplies your wealth over the period of time, right? So this is a summary of what all things we have covered in this presentation. Now, how I can help you with my product basket. Okay, I do mutual funds. I help you with all the other mutual funds like equity, debt, hybrid, ELSS funds, ETF funds, passive funds, and all the other mutual funds categories. I have been into this for last 4 years. In the life insurance part, I help you with the term plan also. Okay, I help you with the other insurance money back plans also. If it is like, if you are okay with the fixed returns, and if you are okay to get those, if you're comfortable with that policies or schemes. Okay, I do general insurance also, like health insurance, car insurance, and of all the other companies, because I have tied up with NJ Wealth, which is a main distributor for all the insurance companies, which is a main distributor for all the mutual fund companies. So I am their authorized partner, wherein you get everything, all the products online, and on the set you get an app, okay, wherein you have the unique login ID and a password, so you yourself can invest into mutual funds. You can invest in the direct stocks, bonds, and gold sovereign bonds as well. Okay, so these are the various product basket what I have. And get in touch with me for these products. Okay, why you should get in touch with me is because I help you map all your life goals for all the investments you make, and I track the progress of your investments on a regular basis. Okay, so like I told you, it is very much important to have a goal in front of you so that you can plan your investments accordingly. So all your investments should be aligned with your goal. Then second, I help you identify your risk profile and recommend a suitable portfolio. I don't simply start with the investments. I just understand what is your risk appetite, how much risk you are able to take, and then accordingly suggest you the suitable product. I have a complete online platform to do all the transactions. You need not have to do any paperwork to start investing in mutual funds. I do take one-on-one portfolio review meetings on a regular basis, so that your understanding about the investments also grows. You are aware what your investments are doing, and also if we in future we need to do certain changes in your portfolios, and if your life situation changes, then these investments also need to be changed. And I focus on providing the financial education, and I conduct these investor awareness programs. I send you the monthly newsletters. Okay, I send some important updates via mail or via SMS, via WhatsApp. Okay, so that you are updated, you have that basic knowledge about personal finance, so that in future you become Atmanirbhar for managing your own finance. And then finally, for all your questions or doubts or queries related to personal finance, where to invest, how to invest, which is suitable for me, all these questions will be answered by a one competent person. Okay, whether it is in the investments in the mutual funds, whether in the investment stock market, whether the investments in the insurance schemes, whether the investments in the government securities, whether your investments is in the NPS, whether your investments in the EPF, whether your investments in the PPF account, whether you have Sukanya Samriddhi account, whether you are retired and having investments in the senior citizen schemes, post office monthly income schemes, all the queries, all the doubts, all the this will be covered by a person who is a financially like a competent person, and who has the CFP certification, and who follows that professional and ethical standards in a financial planning. Okay, so these are the unique benefits, okay, you will get when you have your investments through me. Okay, and I give a commitment of holding your hand till your lifetime, right? So I am available, okay, for you till the lifetime. So these are the contact details. You can get back to me on WhatsApp. This is my number available. This is my email ID. You have any queries, you can mail me. My website is also given. Please follow me on the social media. These are the links. I'm available on Instagram, Facebook, LinkedIn, and YouTube as well. And I try to provide, some valuable information so that I can add some value in your life, right? In the end, okay, before closing this video, I just want to tell you one story, right? I just want to tell you one story. Everybody is aware about Mahabharat, right? Everybody knows Mahabharat, and who is the most powerful and important person in the Mahabharat. Okay, who was the most important and powerful person in the Mahabharat? First image comes to our mind is the Lord Krishna, right? And in the Mahabharat war, okay, what is the role he played in the war, and how he guided Pandavas to win that war. You know that incidents when King Arjun and Duryodhana went to Lord Krishna to ask his help during the war. when the Lord Krishna was, I'll just narrate you that incident. When the Lord Krishna was into his sleep, and when Duryodhana had reached there, he was sitting sitting to him at his head, while the Arjuna was sitting at his legs. And when Lord Krishna woke up, he saw Arjuna first. So he asked, "What do you want?" But then Duryodhana interrupted in between, and then he said that I am the one who came first here. So I should be given the opportunity to, to know what do I need first. So Lord Krishna, gave them the two options. And he asked, he said that either I am available to you, or all the soldiers are available to you. What option do you need? And he asked Arjuna first. Arjuna had both the options. He had thousands of soldiers, okay, of Lord Krishna. And on the other side, he had only one Lord Krishna along with him. Tell me whether he was, whether he was smart or Duryodhana was smart. Arjuna was smart. He was smart because he chose Lord Krishna, because he knew that one single person, even without a weapon, can help him win that war because of his right guidance and with his right advice. Right? Arjuna did not needed his entire thousands of soldiers when he had a one right advisor for him. Friends, even I want you to take that important call in your life. Whether you want those hundreds of people, hundreds of experts, those news channels, those stock traders, those experts, those insurance agents, those investment advisors, so-called financial planners, who will give you different views on different things, or you want one single person, one competent certified financial planner who is going to help you and guide you in all the aspects of your personal finance. Be smart, take that right call, okay? And if you want me to guide you in your financial journey, please get back to me. I will be really happy to help you. And this is how I would like to thank you for being present for the entire presentation, listening it very patiently. Okay, I hope it helped you. I hope I was able to add some value through this in your life. Okay, I would be happy to guide you in your future journey as well. Thank you so much.